Modern Real Estate Practice, page 372. The property manager may be entitled to a commission on new rentals and renewed leases. Equal opportunity statement. Residential property management agreements should include a statement that the property will be shown, rented, and otherwise made available to all persons, regardless of race, color, religion, sex, disability, national origin, or family status, and to any class of person protected by local, state, or federal law. Math concepts. Rental commissions. Residential property managers often earn commissions when they find tenants for a property. Rental commissions are usually based on the annual rent from a property. For example, if an apartment unit rents for $1,200 per month and the commission payable is 8%, the commission is calculated as follows. $1,200 per month times 12 months equals $14,400. You take that $14,400, you multiply it by 0.08, it equals $1,152. The property manager's responsibilities. Property management begins with a management plan prepared by the property manager. A management plan outlines the details of the owner's objectives with the property, as well as what the property manager expects to accomplish and how, including all financial objectives. The management plan. In preparing the management plan, a property manager analyzes three factors: the owner's objectives, the regional and neighborhood market, and the specific property. Occupancy, absorption rates, and new starts are critical indicators. The plan also includes a budgetary section on sources of revenue and anticipated expenses. While the management plan is a document for the present, it is forward-looking in determining the feasibility of a property owner's long-term goals for a specific property. Financial reports. One of the primary responsibilities of a property manager is maintaining financial reports, including an operating budget, cash flow report, profit and loss statement, and budget comparison statement. While there are no standard formats for these reports, there is some similarity among the reports, and it is important for the property manager to adapt a report to meet an owner's needs. The reports are sent to the property owner at the agreed upon intervals by mail or email, but the property manager should meet the client at least once a year to go over the property's financial status in detail. Not only is this helpful to the owner's understanding of the property's performance, it is an excellent way for the property manager to demonstrate the levels of service and expertise that are being provided to the client. Operating budget. The projection of income and expense for the operation of a property over 1 year period is called an operating budget. This budget, page 373, developed before attempting to rent property, is based on anticipated revenues and expenses and provides the owner with the amount of expected profit. The property uses the operating budget as a guide for the property's financial performance in the present and future. Once a property manager has managed a property for a length of time, an operating budget may be developed based on the results of the profit and loss statement in comparison to the original budget. Actual versus projected. After making the comparison, a new operating budget is prepared for a new term period in the future. Cash flow report. A cash flow report is a monthly statement that details the financial status of the property. Sources of income and expenses are noted, as well as net operating income and net cash flow. The cash flow report is the most important financial report because it provides a picture of the current financial status of a property. Income. Income includes gross rentals collected, delinquent rental payments, utilities, vending machine proceeds, contracts, late fees, and storage charges. In some properties, there is space that is not income producing, such as the property manager's office. The rental value of the property that is not producing income is subtracted from the gross rental income to equal the gross collectible or billable rental income. Any losses from uncollected rental payments or evictions are deducted from total gross income to arrive at net operating income. Expenses. A property will incur both fixed and variable expenses. Fixed expenses are those that remain fairly predictable, even though they may increase or decrease somewhat, such as employee wages and other administrative expenses, utilities, and other basic operating costs. Variable expenses may be reoccurring or non-reoccurring and can include capital improvements, building repairs, and landscaping. Cash flow. Cash flow is derived as shown below. The entry for debt service in the third equation includes any mortgage payments on the property. It shows gross rental income plus other income minus losses incurred equals total income. Total income minus operating expenses equals net operating income. Net operating income minus debt service minus reserves equals cash flow. Profit and loss statement. A profit and loss statement is a financial picture of revenues and expenses used to determine whether a business has made money or suffered a loss. It may be prepared monthly, quarterly, semi-annually, or annually. The statement is created from the monthly cash flow reports and does not include itemized information. A formula for a profit and loss statement is as follows: gross receipts minus operating expenses minus total mortgage payment plus mortgage loan principal equals net profit. Budget comparison statement. The budget comparison statement compares actual results with the original budget, often giving either percentages or a numerical variance of actual versus projected income and expenses. Budget comparisons are especially helpful in identifying trends in order to help with future budget planning.